Global markets are primed for a relief rally after U.S. negotiators agreed to a tentative deal over the weekend to resolve a debt crisis that has battered risk sentiment 7-4 in recent weeks. The U.S. dollar, which has benefited from angst around the statutory borrowing limit, will be in focus as another week of trading begins at 5 a.m. Monday in Sydney. The liquidity is set to be thin, with U.S. and U.K. markets closed Monday for national holidays, although futures contracts referencing U.S. Treasuries and the S&P 500 index will trade. Investors had flocked to safety in recent weeks as the so-called ex-date, the day on which the Treasury expected it wouldn't be able to meet all of its obligations, rapidly approached. House Speaker Kevin McCarthy said he will talk with President Joe Biden again on Sunday and line the bill up for a vote on Wednesday. Markets should breathe a sigh of relief, with the dollar likely to soften a tad as the debt ceiling imbroglio is finally resolved, said Changlei Liang, a strategist at DVS Group Holdings in Singapore. The deal appears well balanced between reducing spending while not jeopardizing growth, and is likely to be a small positive for U.S. Treasuries. Somewhat ironically, the prospect of U.S. defaults has been a boon for the dollar, with the U.S. dollar advancing against all of its Puka 10 peers this month. The currency's outperformance steamrolling even the traditional safe haven yen, which fell to 6-month lows past 140 per dollar last week, reflects the U.S.'s unique position at the event center of the global financial system. Even when the nation is flirting with default, investors have little choice but to flock to dollar-denominated assets like treasuries for protection. An MOI Pulse survey earlier this month showed U.S. debt was second only to gold as the most popular asset to buy in the event of a default. To be sure, Treasury market investors have remained optimistic about the prospects for a debt deal, with swap traders now pricing at about a quarter-point rate hike over the later on the Federal Reserve policy meetings, implying the central bank will be able to retain its focus on fighting inflation. So the costs of weeks of political wrangling have already taken a toll. The U.S. Treasury has paid $80 million more to issue bills in the wake of earlier warnings in from Yellen about running out of cash. For deputies said Thursday, Wall Street watchers meanwhile say that a subsequent push by the government to refill its coffers in the wake of yield quickly drain liquidity from the banking system. This will mean all the more pressure on U.S. banks after months of turmoil. A deluge of bill supply could be another boost to the dollar, according to BPON. Rai, head of FX strategy at Canadian Imperial Bank of Commerce. We are becoming more sensitive to the view that greenback strength might be persistent, given the deluge of bill supply once things settle, and what that would mean for a financial system liquidity. Rai wrote in a note to clients last week, the